February 28th, 2026. Today, right now, as you watch this, the United States and Israel launched Operation Epic Fury. Joint air strikes on Iranian military and nuclear facilities across multiple cities. Tran, Isfahan, Kay, Karaj, Iran retaliated within hours. Missiles launched at Israel. Attacks on U.S. military bases in Qatar, Kuwait, Bahrain, the United Arab Emirates. One person killed in the UAE. Reports of 40 casualties at a school in Iran. Israel has declared a 48-hour state of emergency and closed its airspace. This is not a drill. This is not a simulation. This is happening right now. And in 72 hours on Monday morning, March the 2nd, global financial markets open. Traders in New York, London, Tokyo, Hong Kong will walk onto trading floors and decide what this means. What price should oil be? What are stocks worth in a world where 20% of global oil supply might get cut off? What is the fair value of a retirement account when the Middle East is on fire? The estimates are staggering. Former IMF Deputy Director Geeta Gopinath warned earlier this year that a major stock market crash could wipe out $35 trillion in global consumer wealth. $35 trillion. That is more than the entire U.S. economy. But is that realistic? Is a $5 trillion crash, the number in our title, even possible? What are the actual mechanisms that turn bombs in the Middle East into losses in your 401k? Today, we are going to break this down, not with speculation, not with fear, with data, with history, with the cold, hard economic mechanics of how wars impact markets. We are going to look at what happened in past conflicts, what experts are forecasting for Monday, what the Strait of Hormuz actually is, and why it matters so much. And most importantly, what this means for you, your gas prices, your grocery bill, your savings, your future. This is not about politics. This is not about who is right or wrong. This is about understanding the financial reality of living through a major geopolitical crisis. Let us start with the number everyone is talking about. 5 trillion? It is in the title. It sounds massive, and it is. But is it accurate? Let me give you context. The total global stock market capitalization, the combined value of every publicly traded company on Earth, is approximately 124 trillion as of 2025. A $5 trillion loss would be about 4% of that total. That is a bad day. A really bad day, but not a catastrophic crash. In fact, markets already experienced something close to that earlier this month. During the February 2nd through 6th flash crash, triggered by fears about artificial intelligence and economic data, global markets lost what analysts described as trillions in value in just days. So 5 trillion, that is plausible. That could happen on Monday. It might already be priced in to some degree. But here's where it gets more serious. Geeta Gopinath, the former first deputy managing director of the International Monetary Fund, one of the most respected economists in the world, warned in January 2026 that a major market crash could wipe out 35 trillion. 35 trillion, not 5, 35. That is a 28% crash from 124 trillion to 89 trillion. That would be one of the worst market crashes in modern history. Worse than COVID, comparable to 2008, potentially approaching 1929 Great Depression levels in terms of percentage loss. Is that likely? No. Most analysts think that is a worst-case scenario. A nightmare outcome where everything goes wrong at once. The war escalates, oil spikes to $200 per barrel. The Strait of Hormuz closes for months. A global recession begins. Panic spreads. But is it possible? Yes. The conditions exist. The leverage exists. The interconnectedness exists. The fragility exists. So when we talk about a $5 trillion crash, understand that 5 trillion might be the optimistic scenario. The real question is not if markets fall on Monday. They almost certainly will. The question is how far? 5 trillion, 10 trillion more. Let us look at what drives those numbers. There is a narrow waterway between Iran and Oman. At its narrowest point, it is just 21 miles wide. It is called the Strait of Hormuz, and every single day about 20 million barrels of oil pass through it. 20 million. That is roughly 20% of all the oil consumed on Earth every day. Saudi Arabia exports 5.5 million barrels per day through the strait. The United Arab Emirates, Kuwait, Iraq, Qatar, all of their oil goes through this one choke point. The value of the energy that transits the strait annually is about 500 billion, half a trillion every year. And Iran sits right on top of it. They control the northern shore. They have missiles. They have mines. They have small, fast attack boats. They have threatened multiple times over the past decades to close the strait if attacked. So, here's the scenario that keeps oil traders and Pentagon planners awake at night. The war escalates. The United States hits more Iranian targets. Iran, in retaliation or desperation, closes the strait. Maybe they sink a tanker in the shipping channel. Maybe they lay mines. Maybe they credibly threaten to attack any ship that tries to pass. Whatever the method, the result is the same. Oil stops flowing. 20 million barrels per day, gone overnight. Now there are workarounds, pipelines that bypass the strait. The East-West pipeline in Saudi Arabia can move about 5 million barrels per day. The UAE has a pipeline to the Arabian Sea that can handle around 1.5 million. But that is only 6.5 million combined. You still have 13.5 million barrels per day that cannot get to market. That is nearly 14% of global oil consumption just gone. What happens to oil prices when 14% of supply disappears? Right now, Brent crude, the global benchmark, was trading around $73 per barrel. West Texas Intermediate, the U.S. benchmark, was at $67. Those prices are about to change dramatically. Venari, founder of Vonda Insights, said markets are expecting a knee-jerk jump to $80 per barrel. $80. That is a 10% jump just from the initial fear and uncertainty. But that is the mild scenario. That is if the war stays limited, if Iran does not close the strait, if oil keeps flowing. Lombard Odier, the Swiss private bank, said a temporary spike above $100 per barrel is plausible if hostilities escalate. $100. That is a 37% increase from current levels. That is what happened during the Russia-Ukraine war in 2022. Markets panicked, oil spiked, then came back down as traders realized supply was not actually disrupted that much. But what if the strait closes? What if 20 million barrels per day stop flowing? Oxford Economics modeled this exact scenario. They found that if the Strait of Hormuz closes completely for just 1 week, oil prices could spike to $140 per barrel. 1 week, $140, nearly double current prices. And if the closure lasts longer, 30 days or more? Long Yield, a Substack analysis, modeled a sustained closure. Their estimate, $180 to $200 per barrel. $200, nearly triple current prices. Let me put that in perspective. In 1973, during the Arab oil embargo, OPEC removed about 4.4 million barrels per day from the market, about 7% of global supply at the time. Oil prices went from $3 per barrel to $12 per barrel, to 300% increase. If the strait closes, we are talking about removing 20 million barrels per day, 20% of supply, 4 times larger than the 1973 embargo. If 1973 caused a 300% price spike from removing 7% of supply, what does removing 20% do? The math is ugly. $200 per barrel might be conservative. Now, let me explain how a spike in oil prices crashes the global economy. It starts at the gas pump. Oil goes from $70 to $150 per barrel. Gasoline prices in the United States, which are about $3 per gallon right now, double to $6 per gallon. For the average American driving 12,000 miles per year at 25 miles per gallon, that is an extra $1,400 per year just in gas. $400 taken directly out of household budgets. But it is not just gas. It is everything. Diesel fuel, which powers trucks that deliver goods to every store, also doubles in price. Shipping costs explode. Companies pass those costs to consumers. Your groceries cost more. Your Amazon orders cost more. Everything costs more. Airlines face jet fuel costs that have doubled. They either raise ticket prices or cut routes or both. Business travel becomes prohibitively expensive. Leisure travel collapses. The airline industry enters crisis mode, impacting tourism. Petrochemical manufacturers, companies that make plastics, fertilizers, pharmaceuticals, all see input costs explode. They raise prices, pass costs to consumers. Inflation accelerates, and all of this happens while the Federal Reserve is fighting inflation. They cannot cut interest rates to stimulate the economy because inflation is spiking again. They are stuck, trapped between a crashing economy and rising prices. This is called stagflation. Stagnant economic growth plus inflation. It is the worst case scenario for policymakers, and it is exactly what happened in the 1970s. Oxford Economics modeled the economic impact of a 3-month Hormuz closure. Their findings: GDP contractions of 1.5 to 3% for major oil importing countries, inflation increases of 2 to 4 percentage points, and recession risk above 75%. A 3-month closure, 75% recession risk. And remember, Iran's oil exports are about 1.7 million barrels per day. 90% of that goes to China. If the strait closes and China cannot get Iranian oil, the world's second largest economy, already slowing, could tip into recession. Global recession triggered by a conflict in the Middle East over a 21-meter wide strip of water. That is how you get from bombs in Iran to losses in your 401k. Now, before we panic, let us look at history. Middle East conflicts are not new, and markets have dealt with them before. In June 2025, less than a year ago, Israel and Iran fought a 12-day war. Iranian-backed militias and Hezbollah launched attacks. Israel responded, missiles flew, cities were hit. Oil prices spiked. Brent crude hit over $80 per barrel, a 3-year high at the time. The Iranian stock market crashed, falling 15%. Over $700 million in sell orders piled up. 750 stocks hit their downward price limits and could not trade. But here's the interesting part. Global stock markets did not crash. In fact, according to analysis by Pfizer Investments, global stocks actually rose. Why? Because the war stayed contained. It did not spread. Oil kept flowing. The strait stayed open. After 12 days, a ceasefire was reached. Markets breathed a sigh of relief and moved on. The 1991 Gulf War. Iraq invaded Kuwait. The United States and allies launched Operation Desert Storm. Oil prices spiked from $17 per barrel to $36, a major war in the heart of the Middle East. But the spike was temporary. Once the coalition secured Kuwaiti oil fields, prices came back down. Markets wobbled but did not crash. The U.S. entered a mild recession, but it was short-lived. The 2003 Iraq invasion. Oil was around $30 per barrel before the war. It spiked to nearly $40, but within months, it was back to pre-war levels. Markets corrected briefly, then resumed their bull run. History suggests that regional Middle East conflicts do not typically cause prolonged global market crashes. Wars end, oil flows resume, markets recover, but there are key differences this time. In past conflicts, the goal was limited. Remove Iraq from Kuwait, prevent weapons development, degrade terrorist infrastructure. This time, the goal is regime change in Iran. Bombs will be dropping everywhere. The Iranian government overthrown and replaced. That is not a limited strike. It's an attempt to fundamentally restructure the political order of the Middle East's second most populous country. Iran knows it, which means they have no incentive to de-escalate. If the choice is between losing power or fighting back, they will fight. That is why Iran retaliated immediately. Iranian missiles were flying at Israel and U.S. bases. This is not a country backing down. This is a country at war. The second difference is scale. The U.S. military buildup in the region is the largest since the 2003 Iraq invasion. Multiple carrier strike groups, bomber deployments, special forces on the ground. This is a sustained campaign. They have proxy forces across the region, Hezbollah in Lebanon, Houthis in Yemen, militias in Iraq and Syria. They can strike Israel and U.S. bases. They can attack oil infrastructure in Saudi Arabia and the UAE. Most importantly, they can threaten the Strait of Hormuz in ways previous adversaries could not. So when you combine explicit regime change goals with massive military deployments and an adversary with capability and motivation to cause maximum economic damage, you get a conflict that is fundamentally more dangerous than past Middle East wars. This is not Gulf War II. This is something new and potentially much worse. 72 hours from now, Monday, March 2nd, 8:30 a.m. in New York. Markets open. Here's what traders expect to happen. Oil futures will gap higher. The term gap means the opening price is significantly higher than the previous close with no trading in between. Oil will likely open at $80 per barrel or higher, possibly $90. If there's any hint of Strait of Hormuz disruption, it could open above $100. Energy stocks will surge. ExxonMobil, Chevron, CocoPhillips, Marathon, any company that produces oil benefits when prices spike. Their revenues go up, even if their costs stay relatively flat. Expect energy stocks to be up 5 to 10% or more. Defense stocks will also surge. Rathon, Lockheed Martin, Northrop, Grumman. War means demand for missiles, bombs, aircraft, ships. Defense contractors will see their stock prices rise even as broader markets fall. Safe haven assets will rally. Gold, already up 22% year-to-date in 2026, will likely hit new all-time highs. The Swiss franc will strengthen. The Japanese yen will strengthen. U.S. Treasury bonds, despite all their problems, will see buying as investors flee risk. Everything else will fall. Technology stocks, consumer discretionary, airlines, retail, anything that depends on a healthy economy and low oil prices will get hit. Ryan Leand, an analyst at Neovision Wealth Management, told Markets Reporter last week that Gulf stock markets are expected to drop 3 to 5% on Monday. That is the region ground zero. They are pricing in the direct impact. But the key indicator will be the VIX, the volatility index, the fear gauge. It measures expected volatility in the S&P 500. Right now, it is above 20, which is already elevated. Normal is around 12 to 15. If the VIX spikes above 30 on Monday, that signals panic. Above 40, that signals crisis. Above 50, we are in 1987 Black Monday territory. Watch the VIX. That will tell you how scared the market really is. Okay, so markets crash. Oil spikes. Recession looms. What does that actually mean for you sitting at home watching this video? Let me make it concrete. If oil goes to $150 per barrel and stays there for several months, gasoline prices in the United States will hit $6 per gallon or higher. If you drive a typical amount, that is an extra $1,400 per year just for gas. But it is not just gas. Your utility bill goes up because natural gas prices rise in sympathy with oil. Your grocery bill goes up because shipping costs rise. Your airline ticket costs more. Your Uber costs more. Everything that moves costs more. Inflation, which was finally cooling down to around 2.5%, spikes back up, maybe to 4%, maybe to 5%. Your paycheck buys less, your savings lose value, your budget gets squeezed. If the Federal Reserve responds to slowing growth by cutting interest rates, your savings account earns less, your money market fund yields drop. But if they keep rates high to fight inflation, your mortgage stays expensive, your car loan stays expensive, your credit card debt stays expensive, you are trapped either way, and your 401k, the stock portion of your retirement account, likely falls 10 to 20% in a moderate scenario, 30 to 40% in a severe scenario. If you're close to retirement, that is devastating. Your plans get delayed by years. If you are young, decades from retirement, a crash is actually an opportunity. You are buying stocks at lower prices. When markets recover, you make money. But the pain in the short term is real, so this is not abstract. This is not just numbers on a screen. This is your financial life, your plans, your security. All of it tied to events happening 7,000 dollar away in the Middle East. 3 scenarios: mild, moderate, severe. Let me give you 3 scenarios for how this plays out with rough probabilities based on current data and expert analysis. Scenario 1, limited conflict, quick resolution, 40% probability. In this scenario, the strikes are effective. Iranian military infrastructure is degraded. The regime feels pressure but does not collapse. Some kind of negotiated settlement, possibly brokered by Russia or China, emerges within weeks. Oil spikes to $90 to $100 per barrel, but comes back down within a month as the strait stays open. Stock markets drop 5 to 10%, recover half of that within weeks. The $5 trillion loss headline becomes reality, but it is temporary. Markets bottom and start recovering by April or May. This is the optimistic case, and there is historical precedent. Most Middle East conflicts stay regional and resolve relatively quickly. 40% probability. It is possible, maybe even likely if cooler heads prevail. Scenario 2, prolonged conflict, economic damage, 45% probability. Most likely, this is the base case. The war drags on for months. Not full-scale invasion, but sustained airstrikes, missile exchanges, proxy attacks throughout the region. Oil hovers between $120 and $150 per barrel. The strait does not fully close, but shipping insurance costs spike. Some tankers avoid the area. Effective supply drops by 5 to 10%. Global recession becomes a reality. GDP growth turns negative in the second half of 2026. Stock markets fall 20 to 30% from current highs. That is 10 to 15 trillion in losses globally. Inflation stays elevated. The Fed stays stuck. Consumers pull back spending. Companies lay off workers. Unemployment rises from 4% to 6%. This is painful but manageable. Not a depression, a recession. It lasts 12 to 18 months. Markets bottom in mid to late 2027. Recovery begins, but is slow. 45% probability. This is the most likely path given the stated regime change goal and Iran's ability to sustain conflict. Scenario 3, catastrophic escalation, 15% probability. The nightmare, Iran closes the Strait of Hormuz. Mines are laid, tankers are attacked, oil spikes to $200 per barrel, 20 million barrels per day offline. Global panic. Stock markets crash 35 to 40%. The $35 trillion loss Geeta Gopinath warned about becomes reality. Major economies enter severe recession. Unemployment spikes to 8 or 10%. Multiple countries face financial crisis. Banks fail. Credit freezes. Central banks print money in emergency mode. Inflation and recession at the same time. The geopolitical situation spins out of control. Israel launches broader strikes. Hezbollah enters the war fully. Regional allies take sides. The conflict spreads. This is low probability, 15%, but it is not zero. Wars escalate, miscalculations happen. Desperation leads to extreme actions. And if it happens, the economic damage lasts for years. This is 2008 level crisis, possibly worse. Over the next week, these 5 indicators will tell you which scenario is unfolding. You can track this in real time using marine traffic websites. If tanker traffic through the strait drops significantly, if ships start rerouting around Africa, that signals fears of closure. Normal is about 18 to 20 tankers per day. If that drops below 10, worry. If it drops below 5, panic. Anything below $100 is the mild scenario. 100 to 130 is moderate. Above 130, we are in severe territory. The opening price sets the tone. It tells you what the smartest traders in the world think is going to happen. Does Iran keep retaliating? Do they hit more targets? Do they activate Hezbollah? Do they threaten the strait explicitly? Or do they pull back, make diplomatic noises, look for a way out, watch Iranian state media, watch statements from their leaders? That will tell you if they are preparing for a long war or looking for an exit. Is the U.S. sending more assets to the region? More carriers, more bombers, more troops? Escalation of military presence suggests the Pentagon expects a prolonged campaign. De-escalation suggests they think it will be short. Gold prices, treasury yields, the VIX. If all 3 are screaming, if gold is hitting record highs, if the VIX is above 30, if treasury yields are plunging because everyone is buying bonds, that signals maximum fear. Fear does not necessarily mean the worst will happen, but it means markets are pricing in that possibility and market expectations become self-fulfilling. Let me bring this all together. As of today, February 28, 2026, the United States and Iran are at war. It happened this morning. Bombs have been dropped, people have been killed, missiles have been fired. In 72 hours, global markets have to decide what this means. How long will this last? How bad will it get? Will oil keep flowing? Will the global economy hold up? Nobody knows. And that uncertainty is what crashes markets, not the war itself. The uncertainty about the war. If everyone knew with certainty that the conflict would last exactly 2 weeks, that oil would peak at $110, and that a ceasefire would be signed on March 15th, markets would probably be okay. You could price that in, calculate the damage, move on. But we do not know. This could end next week with a diplomatic settlement, or it could rage for months, or it could escalate into something catastrophic. And when investors do not know, they sell. They reduce risk, they go to cash, they wait. And when enough investors do that at the same time, markets crash. Is a $5 trillion global loss possible? Absolutely. That could happen on Monday. It might already be inevitable given the events of today. Is a $35 trillion loss possible? Yes. If the absolute worst case scenario unfolds, if the strait closes, if oil hits $200, if panic spreads, if the war drags on for a year, most likely we land somewhere in between. 10 to 15 trillion in global stock market losses over the next 6 to 12 months. A recession, higher oil prices, economic pain, but not collapse. That is the base case. The most probable scenario, but probability is not certainty. And in war, the improbable happens more often than anyone expects. So watch Monday morning. Watch the oil price, watch the VIX, watch the indicators, because what happens in the next 72 hours will set the tone for the entire year. Stay informed, stay rational, do not panic, but do not ignore this either. Thanks for watching.